remember there was one guy that I talked to, and he has a really big portfolio now and all that. He was like, I'm gonna go all in, and either I'm gonna be really right or really wrong. And so he was really right. And so yeah. Anyways, but we made some good money and all that, and definitely wish I had purchased more back then, but coulda, woulda, shoulda. I think that that time, kind of in that 2012, 14, 15, 16, kind of feels like right now this is kind of the GFC for multifamily right now. I mean, we were, before the podcast, we were just talking about, I mean, there's unfortunately there's foreclosures. There's a popular street where I live in Fort Worth. It's called Hewlin, and basically every deal is trading right now.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? Scott Kidd, the Yacht Captain Investor Podcast. I have a friend of mine here, Dustin Miles, a fellow Longhorn. So glad to have another one on the podcast here. How you doing today, Dustin?
Pretty good. I'm doing a lot better than our football team was this last weekend, but
yeah. It's hit or miss. I mean, the last few years they've been pretty good, but then college football, you never know, they change in an instant anyway. But, For people that don't know you or would like to know a little bit about you, just give us your brief intro about yourself.
Appreciate that, Scott. I grew up in Fort Worth, and still live here today. Moved around a little bit, so Scott, you mentioned, went to UT Austin for school. Went to engineering school there, and then kind of after that, I don't know. I've always been pretty entrepreneurial though, and all that kind of. In college, I had a business. As a little kid, I had a few businesses. I sold candy. Like, I was 8 years old. Bus driver called me the Candy Man. So I sold Laffy Taffy and blow pops and
all that stuff.
All that good stuff. So I have a sweet tooth, and I didn't eat all my profits. So that was just taught me about discipline there. But I went to school for engineering, and then got out of engineering and or got out of school, got a job, went to actually College Station of all places, which it was interesting place to be in. I was poor, I didn't have a whole lot of money, so all my shirts were UT this, UT that. And if you're familiar with that rivalry, that's the wrong color of shirt, wrong type of shirt to wear there. I was hissed at on multiple occasions at restaurants and all that. So anyways, but I really wanted to do fuel cell research at the time, and then I don't know, kept on running into guys that did had some single family rentals and all that. I moved to San Francisco just for a year. That's where I started working at Lockheed, and then transferred back to Fort Worth. But and then got here, and I started going to single family meetups and all that. I remember meeting a guy that I think he owned like 24 units, and I'd never met anyone that owned more than like a duplex or a few single family rentals. I was and the deal, he lived in Dallas. The deal he owned was in Oklahoma, somewhere in Oklahoma, and lot in Oklahoma actually. And so I was like, wow, how's he? This guy must be rolling in the dough. Like, wow, and I just didn't have any exposure at the time. This was kind of, when was this? This was like 06, 07, YouTube, I don't even know if it was around, but social media wasn't super super popular at that point either. So there wasn't a whole lot of exposure as far as, learning about, I mean, you have your podcast, like all that stuff wasn't around then back in my day. And so anyways, met him, and then I met some other people, and then I went to Lifestyles Unlimited, met some other people that owned like 100 doors and then 200 doors. I was like, wow, this is amazing. It was super cool. And then this one guy was nice enough to go to lunch with me. He owned about 5,000 doors, and this was back in the day, and they own their big company and all that. And anyways, you kind of start to have belief. You get to know these people, and you're like, they're not really any different than me.
Mm-hmm.
And so really kind of started to have a little bit of confidence that I could do this too. And anyways, super long intro. Sorry about that, Scott. But anyways, I got into multifamily. Started like to dip my toes in the water, so got in 2012, and then prior to that, I did half dozen single family rentals, and then syndicated my first deal in 2014, and then live in Fort Worth, have a 14-year-old son now, and just try to have fun and stay active. So
no, that's great. I mean, it's funny because similar story. When I started going to the meetups or whatever, I didn't really know anybody that owned that many doors and stuff like that. And then a friend of mine, Vu, he told me he had bought and sold a 46 unit and made quite a bit of money.
Oh, wow.
And that was kind of like my light bulb moment as well. And like you're saying, to your point, like when you get around people, you're like, my friend Vu, actually, he told me, he's like, I was like, I said, you can do that? And he said, yeah, you can do it. I did it. Anybody can do it, And I was like, well, at that point, we were having a couple of drinks at the beach. So I said, well, if he can do it, then I definitely can, But 2014, for you getting into it, that must have been a pretty good run for a while.
It was interesting. I think the group that I was in at the time, and just kind of at least all the people that I had around me, surrounded, around me, everyone was like, when is GFC going to happen again? And so that was kind of, there were some people that were all gas, no brakes. I was, I was gas, but not too heavy. So I think I did, 2 deals that year, and kind of honestly averaged, 2 deals a year, kind of throughout my career. So I remember there was one guy that I talked to, and he has a really, big portfolio now and all that. He was like, I'm gonna go all in, and either I'm gonna be really right or really wrong. And so he was really right. And so anyways, but we made some good money and all that, and definitely wish I had purchased more back then, but coulda, woulda, shoulda. I think that that time, kind of in that 2012, 14, 15, 16, kind of feels like right now this is kind of the GFC for multifamily right now. I mean, we were, before the podcast, we were just talking about, I mean, there's unfortunately there's foreclosures. There's a popular street where I live in Fort Worth. It's called Hewlin, and basically every deal is trading right now.
Wow.
Up and down that street. So and unfortunately, to my knowledge, most of those people are getting their equities completely lost, or mostly.
Wow.
So yeah,
that's tough. And I guess it's a mix of loans resetting and a lot of other things, probably coming through, bought at a high price, probably bad operations falling apart sometimes. Probably.
Yeah, I think most of, I mean, there's one, there's a few of them that we tour. I mean, they're really nice. They did their business plan. They upgraded the units. The rent bumps didn't,
Didn't take.
the market didn't cooperate on the rent bump side. So that was unfortunate. And then, they got a bridge loan. And so they,
Mm,
they were out of their train track was coming to an end, and so they had to sell. There's another over there that the equity, it was a larger equity group, and the loan's not due or anything like that. They just decided they wanted to sell, and so
mm.
they have to sell. And yeah, it's not unfortunately not not a good result for anybody.
Yeah, I've heard of a few people I know have dealt with some larger equity groups, and
Hmm.
they stick to their plan if they want to sell in 5 years, regardless of whatever it is. They're like,
Yeah.
"Yep,
Yep.
we got to get out," and it's like, "Well, we can hold it another year, and or 2 years, and the investors and everything will be better." And
Yep.
unfortunately, that's not the case. But I resonate with you what you were saying, 14, 15, 16, 17. A lot of people were saying, oh, it's going to crash again. It's going
Hmm.
to go down because everything was at that point was pretty well red hot. And I
Hmm.
remember around 2019, I was like, this can't go on too much longer and everything. And
Yeah.
everyone was kind of the sentiment. So it's easy. You hear a lot of people saying that now that, oh, if it was 2012 again, I'd buy everything and, this and that. And my response is usually, no, you wouldn't, because you didn't do it then either.
Hmm.
Probably gonna think about it now because I did the same thing. I was like, oh man, it was but I had a different mentality. When house across the street from me, sold for $27,000, and
Wow.
I thought about it. I was like, oh man, my house is worth 60,000 or whatever it was, and I bought it for 138,000. I was like, oh man,
Wow.
this is awful. And then like it took about a year or so for that to click, and I'm like, oh wait a minute, no, 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 I'm thinking about this all wrong. And at that point, it was people started buying the houses in blocks of 10, 20,
Mm.
30. So
Yeah.
so I missed that one. But I think anywhere in a decent place, if you can buy a house for 27,000, I think you're probably going to be okay.
Yeah. Right. Yeah. That's
Yeah,
pretty cheap. Yeah.
yeah, you're not going to see that again. I mean, the house now is probably worth 400 something like that.
Yeah.
400.
Where is that house at?
That was in Fort Lauderdale.
Oh, okay.
Yeah, and no, but I mean, it was they're all older houses and everything else,
Hmm.
but it was there was just kind of you have to have the mindset, you have to have the different mentality to really see those things. Whereas
Yeah.
like when you're around all those people, I remember 2019, a guy that I worked for, he said, "Well, we got about 2 years, or there's no way it was 2000. I think it was 2018. Sorry, 2018, like January." And he said he was a pretty sharp guy. He was at a whole bunch of companies and everything, and he worked for Berkshire Hathaway at one time, and he said,
Oh, wow.
"Yeah, we got about 2 years." And sure enough, like February 2020, COVID.
Yeah.
Remember,
Wow.
you had the 2018 yield curve. I mean, 19 yield curve inverted, and then within 3 4 months, things started to unravel. Then
Wow.
COVID happened, and
Wow.
then it was starting to fall out. And I was like, "Wow, he really hit the nail on the head."
Yeah.
But then what happened there?
Yeah.
It
Yeah.
printed a ton of money.
Yeah, we sold I sold I think 4 deals in 19, something like that between, or no, it was five between late 18 and 19. I sold, yeah, 5 deals. It was kind of a, similar, I mean, it was, unfortunately, this deal's gone back to the lender, but I mean, actually we sold this one in 21 or 22, but yeah, I mean, we sold because I was like, I don't. It feels like we're at the
Yeah, at the
top. I
top.
don't know
Yeah.
if we are, but it
Yeah.
feels pretty frothy. And I remember this deal we bought. It was a '60s deal. It was a good area, but it was a '60s deal with a chiller and all that stuff, in a really good part of town, good schools and all that. Good household income for the area. And but we bought it. Can't remember what I don't remember. I think we bought it like a 6 cap or something like that. Anyways, or maybe it was 7 cap, but we sold it at I think at a 4 or 4.5
Wow.
cap, which I mean that's super great. I mean it
It's
was
phenomenal.
basically,
Yeah.
yeah. I mean it was pretty close to the cap rate. You could buy new stuff, and that was a
Yeah.
'60s build. And unfortunately, that deal's the lender has control of it now. We sold it, and so the new buyer. I don't understand how, because it was super. It was very easy to operate, so I don't know what happened, but anyways, the operations tanked, and I don't know, they just didn't do well with the banks. They're doing a short sale on it right now, and I don't I don't see how they get their loan amount. So
So it'd probably be one of those things where they take a lesser amount, more than likely. Probably going to have to.
yeah, it is. I think they just way overpaid, and it was too bad because it's. I mean, it's a, like I said, good deal, good area, good schools, and so yeah, just kind of tough situation. So
Yeah, every one of these deals has a unique story for sure. I
hmm
mean, sometimes you never know. It could have been partnership falling out, or something. Operations could be falling apart, or maybe they didn't get the rents going up like you were saying before. That could
yep,
always be an issue that. Um, so you never know. That 2019 frothy everything. We were all thinking that same. I was thinking that same thing around then too, and then 2020 happened, and then the real top didn't happen until 2021, 2022, right? Something like
hmm
that. And then there's a lot of people that sold out 2020, 2021 and did quite well.
yep,
2022, well, now you're seeing those deals come out.
yep,
Yeah,
yep,
but like you said that we were talking before. You guys had bridge debt on a deal, and people, it has a bad rap right now, but it's all about really the amount and type of leverage that works for the deal. And it's unprecedented the amount that the rates went up. So
hmm
I didn't think anyone anticipated that, and some people got caught. They could be running a great operation, and the rates got them. They couldn't reset the loan. So
yeah. Like I said, I mean, a bunch of the deals we're looking at now. I mean, they're being run really well, good occupancy, and they went through their business plan, and they're running out of time, and their loans up, and they can't. The thing is with bridge loans, you have 1-year extensions. Typically, that's a typical setup, and the problem is you have to look at the hurdles that are
oh
involved
yeah,
in those, and so there's different hurdles to be able to. You have to have certain debt yields or certain NOI or whatever to hit
yeah.
to get those extensions. So it's been challenging. Yeah, if you want, I can. I mean, I can. We've been touring a bunch of deals around DFW and Houston. I'm happy to kind of give you a lay of the land of what we're seeing and all that.
Yeah, that would be great if you could give us what you're seeing as far as a little market update of what's happening.
Yeah. I mean, one of the deals that we were approached by a broker about a deal, and we've been approached by a few, just hasn't worked out. But we're approached by a broker, and so we're potentially we'll see if it works out. The others haven't, but to where we potentially taking over a deal, the lenders in control. We've seen a little bit of that, and so we'll see where that goes. We're looking at there's actually 2 or 3 deals right now that we offered on. I think we were in the best and final in all three of those, and none of those closed. The buyer couldn't perform, and so those are coming back. And one of them's really attractive to us because it's a loan assumption with a really great rate, and it's a good part of town. It's a good deal and all that too. And so you get some real nice positive leverage between the buy cap rate and then your interest rate. So we like that quite a bit. So looking at that one, and then there's a few others that we may offer on. I'm not as I like the deal a lot, but one deal in particular we own quite a bit around there, and so we're trying to diversify where we're at, but we may throw in potentially a lower offer just to see where it goes. And a lot of this right now, because we're anticipating a lot of these deals that we're offering on, even if we don't win them, we're thinking that a lot of these won't actually get done and get closed. And so anyways, we're tracking stuff very closely, and a lot of the deals that have been put out over the past year, we're going back and calling on the broker. Hey, did that one actually close? Did it not? Just to see if we might be able to pick up some, because it's a real unless you've kind of gone through it, when you're selling a deal, it's a little bit of a beating. Honestly, you're having to, the property, you want to make sure it looks tip top. And you're always having to get, financials over to the broker. You gotta, anyways, there's a lot, that occurs, and you really kind of get beat up through the process. And then, if you don't sell, then it's like, or if you had someone that was under contract and then they didn't perform, and then you're like, man, I gotta do all this all over again. And then you've already lost 30, 60 days potentially. And then you gotta go back. Okay, let's go back to the band or go back to the group and see, who could actually
back
perform.
On the market.
Yeah. And you're like, man, this is tough. And then you probably have, you may have a lender breathing down your neck, or investors. And so there's a lot. And so we might be able to pick up some pretty attractive deals, because there's not, I think someone was telling me, I went to the Old Capital conference, and they were saying how a third of the deals refi, a third of the deals close, and then a third of them, like, nothing happens.
It just goes nowhere.
Yeah,
that's good. That's a large percentage. That was one of the things I was going to ask you what you were seeing. Like, because I've seen over, especially like last year, saw quite a few deals that just didn't make it to the finish line, and I imagine we're still seeing it now. Probably got next year and good part of 27, probably for more of it to come. Fruition, really.
Yeah, I think there's a lot of, it's really we had my business partner built kind of a deal tracker, because there's so many deals. There's a lot of deals, and so for us, we're trying to sift through and like which ones make sense, which ones don't, and there's definitely a flight to quality. So if you're in an inferior location, it's gonna be tough going for you. So I just there are a lot of deals out. I would just caution investors to the biggest thing you can't change at the end of the day is your location. You can make it prettier, different color, paint, whatever. You can do a lot of things too, but you can't change your location, and so you just want to make sure you're getting into good, solid locations.
Yeah, location is key, because if the area, if it's too nice for the area, or you just could be in trouble there. You might not be able to get the rents, or it might be tough to operate it there. Attracting the right people to the area, if the area is somewhat marginal, makes a big difference.
Yeah, especially in the market right now. Honestly, rents have been flat or negative for the past few years. It should start I think Houston will kind of, start kind of turn. They were projecting rental increases for this year for Houston. We didn't really see it, just to be honest. And so it depends. It all depends on the pocket too. If we had some pockets where we had a lot of property being built, so that made it challenging. But Houston should be seeing a good amount, a decent amount of rent growth, I would think. Check back with us. Leasing season, March, April, and then we could tell you. But should be in a good spot there. And then DFW, you might see some, but it really depends on the pocket in DFW as well. I've seen some. There's one like where I play indoor soccer, and so where I play indoor soccer, there's 2 complexes at 6 weeks free each. But I've seen others where there's, where I think they've actually seen some rent bumps within DFW. So I always have investors, they're like, how's DFW? I'm like, well, what part? I mean, they're all different.
Big place. It's a big place.
There's almost 8 million people. So
well, I know Houston, just being there a lot, it's the zoning is a big thing too, because you can have anything next to anything pretty much, and so the neighborhoods can be kind of chopped together, and you can have a really nice high rise and then a not so nice one right next to it, and a church, and then a strip club, mall, everything's right there, and then so you really have to, your answer to it depends on the pocket that it's in, because all the secondary markets within Houston are, each one are to each its own. Even within the zip codes, you can go block by block sometimes.
Yep.
And I know DFW is no different either, because I know the northern part of Dallas, you have a lot of new product and a lot of stuff that they were saying was going to be overbuilt, and I know a lot of it got absorbed that came in last year, and that's getting played out a little bit because our development stuff's in the southern part, so we're kind of out of that. So that's a whole nother deal also. So you really have to, like Dustin was saying, you really have to watch your location, because that's really very important. And it's very important just to even drive around and check all the idiosyncrasies of the neighborhoods and stuff like that.
Yep. Yeah, in Houston, that's why you're talking about zoning. That's why we're outside of Beltway 8 on all of our deals, because then you're basically in the burbs, and burbs there are similar to any burbs, but yeah, kind of within Beltway 8, especially within 610, it's kind of, to your point, it's like, there's school, there's guns, there's whatever, and so I don't know if that's legal, but maybe it is. I don't know.
Well, it's Texas. It may not be legal, but it might still be there.
Yeah, that's true. Yeah.
It is quite interesting what they have there, but it works. So that's a good model to be outside the Beltway 8, because I would imagine a lot of that stuff is more stable. A lot of people don't want to be inside in all the traffic and everything else.
Yeah, you get good schools, good jobs, low crime, good household incomes and all that. And to your point, it's not as you still can have some, it can be a little spotty, but it feels just like a lot of the suburbs of DFWs to me. So,
yeah. And there a lot of the stuff out that way is newer product too as well. Yeah. So you got a little more options there with the building and everything else. When you buy it, you're probably not going to be putting roofs on stuff on. You're probably buying Class A stuff anyway, right?
But the stuff we're buying, we bought the deal in Rosenberg we were talking about before this. That one was built in 2003. And so the roofs were 20 plus years old. So we actually replaced them there. And we bought a 90s deal when we replaced the roofs there. And then we saw, it's hard to, actually the ROI was actually pretty decent, because as soon as we replaced the roofs, our insurance went down, because that's one of their biggest,
majors.
Biggest pain points is the roof. And so I can't remember how much we saved. I mean, it was 50 plus thousand, 50 to 100,000. And I don't remember how much our roof was. Our roof was probably, in the $300,000 range for that one deal. And so it wasn't, the ROI was actually pretty decent.
Yeah, that's a pretty good deal, because I know in light of the storms in the past few years, Houston has gotten hit pretty hard, and the insurance went spiked up for quite a bit, and now they're pretty strict about roofs and stuff, because they had to pay out a lot. And here in Florida, it's kind of a similar thing. They've kind of leveled off, because some of the insurance companies have come back in, so it's a little more competitive, but they're still quite a bit higher than they were, in years past, and also because we've taken some big hits too.
Yeah, for sure.
Yeah, no, Houston, probably north of Houston, you don't have to worry about the insurance as much. I would imagine when you get up into Dallas, it's not insurance rates probably moderate, right?
Yeah, it's Dallas is actually not as cheap on the insurance as you would think, just because in the Dallas area they get hail.
Oh, yeah.
And so another thing that kind of beats up on the roof some. So, it's not, yes, there's some savings, especially like compared to deals on the coast, like that are directly on the coast. But yeah, it's not as big of our average portfolio, in insurance number for Houston is about 800 per door.
Okay.
Yeah.
Okay.
It was probably a year or two ago, or probably closer to 2 years. I'd say the average in Houston for our type of products probably around $1,000 a door, and that's come down pretty considerably over the past year or so. So yeah.
Yeah, with a couple hundred doors, and that's quite a bit of savings there.
Yeah. Yeah, we saw some of them. We saw pretty significant. It was we got a few refund checks, $100,000 plus. We're like, oh, this is take this all day long. Usually we need another 100,000. Usually it's going out. So that was kind of
if you get back, that's a good day. That's a good day.
For sure. Yeah. But yeah.
Well, so what do you see going forward over the next 6 months to 2 years for you guys and the market overall? Dallas and Houston.
Yes, we have a portfolio in Houston, about 1,800 units right now. Want to continue to kind of add to that, and then we don't own anything in DFW at all, so we want to kind of replant the flag up here. We have our buy box in DFW is 80s and newer, just kind of well located. Our buy box in Houston is 90s and newer, both 150 units and up. For Houston, we just want to be outside Beltway 8. There's a few deals, like we did look at a deal in the Heights, which is inside of Beltway 8, so there's a few exceptions, but the reason why we looked at that one, it was again kind of a potential takeover situation where the lender was in control, and so we were looking at that. It was a nice deal, just couldn't get the numbers to work out there, but we'd like to not to be like overly aggressive or whatever, but we feel it's a fantastic time to buy, and especially with potential rent bumps around the corner as well. So there's kind of some light at the end of the tunnel. And then, if they I think it could get real interesting. If they do cut rates, but I don't think they need to for it to be, for it to get, pretty interesting. Right now, people are not able to underwrite rent bumps at all, and that's the biggest driving factor on kind of pricing suppression. But we started to see some prices bump up just a little bit whenever the Fed was cutting some. Right now it looks like the Fed, it's a 50-50 toss up whether they're going to cut in December or not. So who knows if they will or not, but we'd like to buy. We think there's some phenomenal opportunities. I don't know how long the window is going to last. I think 12 to 18 months. It's kind of my guess, but we'd like to buy as much as we can, and honestly, we'll probably turn around and sell it in 3 years once the market kind of comes back, and then 1031 stuff, and then kind of just kind of keep trading up. So yeah.
That sounds good. I mean, as far as the rates and stuff, who knows? They're going to do what they were going to do. But I noticed earlier this year when they started talking about the rates and stuff, seemed like everything was kind of priced in a little bit, whatever their little bumps were, or going down. And I really don't see it. It's not going to be like they did before, where they kept them artificially low for a long time. I think that was probably a once in a lifetime thing. I mean, they could go down a point or so, but I really don't anticipate them going down that far. But I don't know. I've been wrong before, So who knows?
I mean, I would have thought honestly that they would have cut more than they have, and it seems like they've been pretty hesitant to. So who knows? Of course, I don't know. It depends on if the Fed chair is replaced, next year, then that could get interesting too. So,
you never know.
Yeah. So, but I think this is 0809 for multifamily right now, and I think the people that get in now will be rewarded in a few years, and and then I think in general, I mean, honestly, just kind of going back to like 2014 to 18 or 19, whatever, like it's not normal to be able to invest 100K and then get 200K plus in like 2 years back. Like that's not normal. That's not healthy. And so I think kind of, getting people, people's expectations. I mean, I like to make double my money in 2 years too, but realistically, is that, going to happen? I don't know, but, I think people's expectations just kind of getting in check and getting kind of in a better place moving forward, I think is healthy. And look, we're probably overpriced, and so we're seeing a pretty major reset right now, probably 25%, off the high. And so anyways, I think everybody needs a place to live, and there's a lot of people moving to DFW and Houston, so I think it's relatively good place to put your money on.
Yeah, I think so. And to your point, everyone did get used to doubling your money in 2 years and 2 to 3 years, and before that it was probably 5 to 7 years. Was normal, and I think we're just kind of getting back to that, and that's going to take a little bit of time for everyone to kind of equalize, stabilize with everything else. But as for what the Fed does, who knows? That could be I mean, but at least they're all back to work now.
Yeah. We just we've got a few refis with HUD, and so we're kind of
up in the air.
They were timeout, paused for a little while. So we're excited to get those rolling, and it'll be good. So
I mean, they take a while anyway. You were alluding to one that took quite some time for the HUD loan as well, and then would imagine with the shutdown now, there's a backlog. probably of.
They're just they're going in and I guess as they were received and as they
Oh,
you
okay, they're
basically have a
just going
plate.
back through.
Yeah, you kept your place in line. So we have one of them that wasn't too far off from I mean, we have holidays and all this other stuff coming up, so it's kind of challenging.
Yeah.
But we're probably gonna have one that we close kind of January, and then I think we'll have one close in February, and then March, and then we'll be done with the refis. So
Oh, that'd be good. That's good. Really
yeah,
good.
yeah. We're
Well,
excited to have those kind of out of the way.
lined up, and then you'll have more cash to deploy into more deals and stuff like that. That's great.
Yep,
Um,
for sure. Yeah.
well, this has been really good. Really great. Having you come on and discuss the Houston and Dallas markets and let us know what you're doing. If people want to find out more about what you're working on and stuff, how do they get a hold of you?
Yeah. Our website's just momentummultifamily.com. My email is just Dustin at momentummultifamily.com. And then I'm all over, I'm getting better about posting on LinkedIn. So just Dustin, middle initial W, last name Miles, like miles per hour. So.
Perfect.
Yeah.
Well, I really appreciate you coming on and spending time with us and giving us a great market update of Texas. We love Texas as well. So thank you very much.
Yeah. Thank you. Yeah. Appreciate it, Scott.
Well, you're welcome. This is the Yacht Captain Investor Podcast. And as a great reminder, the best investment you can make is the one you make in yourself. Have a great time, guys. I'll talk to you next time.